You opened your account a year in, maybe two, and the number sitting there looked like almost nothing. You'd been putting money in every single month, doing the thing everyone told you to do. And the balance barely moved, so a quiet little thought showed up in the back of your head. Maybe this compounding stuff is real for other people. Maybe you started too late. Maybe you're just not the kind of person it works for. You're going to want to hear this part because that thought is the single most expensive thought you will ever have about money. And it's not even your fault that you're having it. Nobody ever handed you the chart. There is a specific picture, a simple line on a graph, one that explains exactly why your account looks flat right now and exactly when it stops being flat. Wealthy families basically grow up staring at that picture. It's on the fridge, it's in the dinner table conversation. You, most likely, were never shown it once. So today, you're getting it. By the end of this, you'll be able to look at your own boring balance and know precisely where you are on the line and how close you already are to the part where everything changes. If you've ever checked your bank app and felt your stomach drop, stay with me. That feeling has an actual cause and it has an end date. Let me show you both. Here's the problem, and it's bigger than you. You were raised on straight lines. Think about it. Your paycheck is a straight line, same number, every 2 weeks. Your rent is a straight line. Your car payment, your phone bill, the money that leaves your account, all of it moves in these clean, flat, predictable steps. $10 plus $10 plus $10. Your whole life trained your brain to expect money to move like a ramp. Steady. One stair at a time. So when you start investing and the account grows in those same slow little steps, at first your brain goes, okay, this is a ramp, I can see the whole staircase from here, and this staircase is way too short. And you get discouraged. Because you're reading a curve as if it were a line. That confusion has a name. Researchers call it exponential growth bias, and it is not rare. In one major study by economists Victor Stongo and Jonathan Zinman, published back in 2009, people across the board underestimated how much invested money grows over time. Follow-up research found that roughly a third of Americans read compound interest as if it were simple interest, as if your money grows in a flat line instead of a curve. Other estimates suggest only around 1 in 5 people picture the growth correctly. Almost everyone gets it wrong in the same direction. Everyone lowballs it. Sit with that for a second. It means the discouragement you felt was never a signal that investing doesn't work for you. It was a bug in how human brains handle time. And it hits hardest on the people who were never taught to expect the curve in the first place. Which, let's be honest, is most of us. As of 2025, only about 19% of U.S. adults say they ever took a personal finance class in high school. That's according to a national report from the financial planning firm Peterson Hastings. 19%. So if nobody drew you the curve, that's not a personal failing. That's a classroom you were never put in. The good news is, states are finally catching up. The number guaranteeing a personal finance course before graduation has more than tripled since 2020, from 8 states to 27, per the nonprofit Next Gen Personal Finance. But if you're an adult right now, you graduated before the fix. You got handed the straight line world and told good luck. So let's actually draw the curve, your curve. Here's how the 2 lines work. One line is the money you put in, your contributions. That line is straight because you add roughly the same amount every month. The second line is the money your money earns, the growth. And here is the whole secret of the chart. In the early years, your contribution line is way above your growth line. You're doing basically all the work. Your money is barely helping. That's the flat part. That's the part that makes people quit. And it feels like failure, but it is the exact opposite. It's loading. Let me put a real number on it so it stops being abstract. Say you put in $300 a month. That's $3,600 a year. In year 1, your growth might add a couple $100 on top. Feels like nothing next to the $3,600 you sacrificed. In year 3, you've handed over more than 10 grand of your own money. And growth has kicked in maybe 1,000 or 2. Still lopsided. If you judged the whole idea by those first 3 years, you'd swear compounding was a myth someone sold you. But watch what the curve is quietly doing underneath. Every dollar of growth you earn doesn't leave. It stays, and it starts earning its own growth next year. Your money is hiring more of itself. slowly at first because the pile is still small. There's a shortcut for seeing this that they should teach in every school and don't. It's called the Rule of 72. You take the number 72 and divide it by your yearly return. At a reasonable long-run return of around 7% after inflation, 72 divided by 7 is about 10, meaning your money tends to double roughly every 10 years. And a quick, honest note before we go further, because you deserve the truth, that 7% is a long-run average, not a promise. Some years, the market drops. This is education, not a guarantee. The long-term U.S. stock market average has historically been closer to 10% before inflation, but I'm using the lower after-inflation number on purpose, so the picture I'm drawing you is conservative, not hyped. So back to your chart. Doubling every 10 years sounds slow. It is slow at the start. The first double barely registers. But the second double is the first double doubling. And the third is that doubled again. The pile isn't adding, it's multiplying. And multiplication is patient right up until the moment it isn't. Now we get to the part of the chart nobody drew for you. The one moment that matters most. There's a specific year on your graph where the growth line finally rises up and passes the contribution line. The year your money earns more in 12 months than you personally put in over those same 12 months. That's the overtake. It's not about your total balance being big. It's about the two lines switching places. The month that happens, something changes that you can feel. You stop being the engine, your money becomes the engine, and you become the passenger. For a lot of people starting from zero with steady contributions, that overtake tends to land somewhere around year 10 to 12. Not 30 years, not never. Roughly a decade of not quitting. That's the whole ball game. And here's what almost nobody tells you about the overtake, because they stop the story right when it gets good. After the lines cross, the gap doesn't stay small, it rips open. Your growth keeps compounding on a bigger and bigger base while your contributions stay flat, because you're still just putting in your $300. By a decade past the overtake, your money in a single year can earn several times what you add. The curve you were never shown becomes almost vertical. And it was always going to. It was baked into the shape from day one. You just couldn't see it because you were staring at the flat part with a ruler in your hand, expecting a staircase. This is why the flat, boring early years are not the years to survive. They're the years that decide everything. Because the height of that final vertical part is decided almost entirely by how much time the small pile got to sit and multiply at the beginning. Quit during the flat part, and you don't just lose a few years of tiny growth. You permanently shrink the base that every future double was going to build on. You take a curve that was about to go vertical, and you snap it off at the ankle. So let me ask you the question this whole video was built to ask. What would actually change if you knew, not hoped, knew, that your flat account is not broken, but loading? That there is a real year on your chart where your money starts out earning you. And that year is closer than a decade for most people who simply don't stop. Because the people who reach the vertical part aren't smarter than you. They didn't find a secret fund. Look at what the data actually shows. When the market drops and everyone panics, one group sells and one group sits still. A 2026 study from the Allianz Center for the Future of Retirement found that about 34% of Americans pull money out of their investments during a big market drop to avoid further losses. A third of people hitting the eject button at the worst possible time. But look at the other side. Vanguard's How America Saves report, which tracks nearly 5 million real U.S. retirement savers, found that even in volatile stretches, only about 5% of them traded at all. The other, 95% did nothing. They let the curve keep bending. That's the difference, and it comes down to one thing that isn't income or intelligence. It's whether you can sit in the flat part without flinching. And that's the identity shift I want you to actually take from this. You are not someone who is behind. You are someone in the loading phase, holding a chart most people never get to see. The person who quietly builds real wealth isn't the one who checks the app every day and rides the emotional wave up and down. It's the one who looked at the boring number, understood the curve underneath it, and refused to sell the future to feel better for an afternoon. You can decide, right now, to be the 95%. That's not a personality you're born with. It's a choice you make every time the line looks flat. Now let me be straight with you, because you've earned it. If you're just starting, or you're a few years in and the number still looks small, you are not behind. You're early on a curve that's about to work in your favor. And if you started later than you wanted to, that's fine too. The second best day to plant this is today, because every year you let the base sit is a year it gets to multiply instead of just add. You cannot buy back missed years, but you have not missed the ones in front of you. One honest caveat so you never get blindsided. The overtake is not a finish line, and the curve does not go up in a clean straight rise. There will be years, even good ones, where the market falls and your balance shrinks for a while. That will feel worse than the flat years ever did because you'll have gotten used to watching it grow. Knowing the shape of the chart won't make a down year comfortable. What it will do is stop you from mistaking a dip for a broken plan and selling the exact thing that was about to pay you. So here's what to do with all this, starting today. Stop measuring your progress by comparing your growth to your contributions every month. That comparison is rigged to discourage you until the overtake, and the overtake might be years out. Measure the thing you actually control instead. Are you still adding? Are you leaving it alone? That's it. That's the whole job in the flat part. I want to hear where you are on the line. Are you still in the flat part, just getting started? Are you closing in on the overtake? Or are you already past it and watching the curve do the work? Drop your year down in the comments. Tell me how long you've been at it. I read them, and honestly, seeing where everyone actually stands is the most reassuring thing on this whole channel. And if this finally made the chart make sense, if you can picture your own curve now instead of just a flat, scary number, subscribe and stay in the flat part with the rest of us who aren't quitting. The version of you that reaches the vertical part is built entirely out of the boring years you don't quit. Start counting them today.